Welcome back to Your Average Investor, everybody. Today we're going to be talking about Nike and if it's a good time to buy or not. If you haven't already, please subscribe to the channel. It does a lot to help support this channel and get this thing monetized so we can do some giveaways and help you guys get some free money. Now, Nike had an absolute plunge on this last earnings call. They dropped, as you can see here, from about $95 per share all the way down to $77, and since then have continued to sell off to where they are now at about $71 per share. So it begs the question, is this a buy the dip opportunity, or should you stay away and wait until something happens before determining if you should buy Nike or not? Now, typically, of course, Nike has always been a buy the dip company. Anytime that you bought the dip in the last 30 years, you would have ended up making money if you just held long enough. Now, that is until, of course, the last couple of years, because they did have a recent high of $179 about 2.5 years ago, and they have not been able to reclaim that high. In fact, if you purchased near highs, you'd be down about 60% from all-time highs right now. So let's dive in, look at the fundamentals, do a little charting, and see if this is a good opportunity to buy the dip or if it's something to stay away and watch for a little while longer. Now, first off, we're going to look at just some basic Nike fundamentals. Income, $7.8 billion. Market cap of $107 billion. And this is, of course, on sales of $51 billion. So they're obviously profitable. They've been profitable for quite some time. And they pay an okay dividend. You can see here their dividend's about 2% yield. And they generally increase their dividend. If we go over to mydividendcalculator.com, we're going to enter in Nike real quick. And you can see that on average, they're increasing their dividend by about 5.6% per year. So if you hold, say, over a 10-year period, you're going to have your dividends increased by about 75% over that 10-year period. Now, the other thing to look at is their price to earnings ratio, which right now is kind of interesting. And the best way to look at this is not in a vacuum here, but to look at the historic PE ratio. So we're going to look at their PE ratio. And as you can see, over the last 5 years, here's Nike's stock price as it climbs from $73 per share all the way up to $164, and then back down now to $73 per share. And if you look at the PE ratio, we're right about in line now with where things were at prior to this incredible surge in the price of Nike, right? So PE was at 29, 30, 31, surged all the way up to 73 before falling, and now we're actually down below this initial area back in 2019, sitting at a PE of 21. So I want to zoom this out just a little bit further so we can see what Nike looks like historically, because prior to these surges, maybe this isn't as good of a deal as it looks like. So here we are now. You can see Nike's historic P&E kind of trails around this $19 to $20 area. So honestly, from a price to earnings perspective, this is not looking all that bad. So let's take a look now at the technicals and see if we can find any good opportunities here through buying the stock and holding. Or of course, if you want to be a little bit riskier, you can buy options as well. And as always, this is not financial advice for you specifically. We're just exploring some interesting ideas, things that you could do if you wanted to play the market, but this is take your own risk, do your own research as always. So here we are sitting at about $71 per share. I'm going to zoom out to this long-term chart so we can see a couple of potential support and resistance zones. And the first one that stands out to me is right here. You can see from back in 2015, Nike hit a high of about $67 per share before selling off, and then it stalled right around that point again in 2018 before finally moving above, and then that started acting as a support for the next bounce. And then we had the COVID dip happen here in 2020 where the price did fall below just briefly, but I'm still going to count that as a potential support zone before, of course, it rocketed up and then came right back down. And then you can see here we've got a new potential resistance if Nike starts rallying right where this used to be support. We may have some resistance building about $82 per share. So where it's sitting right now, I don't see it necessarily being on a support. That being said, the sell-off has been pretty intense and the price to earnings ratio is looking good. I think that there's a good opportunity here for a turnaround. Now, what I probably wouldn't do is play this on the options market because this turnaround could take 6 months, it could take 6 weeks, could take a whole year. But what seems to be the case in my mind is certainly if you buy shares and you're holding for a few years, you're going to make money. Like you're going to get a nice 2% dividend, and the price of Nike is likely going to recover to some degree over the next several years. So I think from a long-term perspective, this is an absolute buy the dip. Now, from a trading perspective, what I would do is I would maybe take a starter here, and as it continued to move down, I would add to that starter position until it started moving back up. However, it hasn't started basing yet. And you guys know I like to see the stock base for several days before entering a position. And it looked like maybe we were going to get a base right here. And then today the sell-off continued. And it was actually pretty steep considering how far it's already gone down. So that's why I'd say instead of entering a full position, if I were to trade Nike stock right now, I would trade it with a starter. The other interesting way to look at this is to possibly play with some cash secured puts. And this is a strategy that I love using when a base hasn't formed because it lets that time just continue to move forward, but I still get to make money along the way. So let's say I was looking at these August 16th puts. This is about a month out, 32 days out. I could sell, say, maybe these put 70s right here, make 120 bucks on that. And of course, I have to put up $7,000 in collateral if I want to do a cash secured put, which is likely what I would do. And but what happens is, number one, if Nike continues to fall, then I have to take Nike shares. I could take 100 shares at $70 per share, which I would be okay with. Again, I think the P&E ratio makes sense. I could always roll it, just like we did with the Children's Place contract in the challenge account. We rolled that because I didn't want it to exercise. We ended up making more premium, rolled it 30 days out, and now we're just waiting in it again. Or the price moves up and you just collect the $120 and move on to your next play. So the premium is not huge. This is the only reason I don't like it necessarily. The premium is not huge, right? If you're talking about what's your return over 30 days, 120 divided by 7,000, that gives you about a 1.7% return over the course of 30 days. It's not a terrible return, right? If you annualize that, you're going to be making about 20, I mean more because if you compound it, but about 20% over a year. So annualized, that's a great return. But it's not phenomenal premium in the options market. So for that reason, I might stay away from selling the cash secured puts. Now, on the call side, it's kind of interesting too, right? Because I could look at some leap contracts if I wanted to. I wouldn't get anything 30 days out if I were to play calls. I probably wouldn't even do anything 90 days out. I'd look at about 1 year out. So somewhere around like 250 days, 340 days, right? And I would look at either just buying an outright call, or I would be doing some sort of spread. So I'd maybe buy these call 75s, sell these call 80s. This is going to cost me $230, and I have a potential profit on this of $267, so just over 100% profit over the course of roughly a year if the price of Nike closes above $80 per share by expiration, or if it flies above it, over the next 30 days because of some news or who knows what, then I could just exit the position early and capture most of the difference there. So that's what I'd be looking at. I mean, like, let's just say you bought, or you could go a little higher up, right? You could get a 90 call. This is going to cost you $220. Just a little bit of quick math here, right? So here's Nike at $90 is right here. Let's say Nike gets to $100 per share by expiration. Well, you're going to 5x your money on that contract. If Nike recovers really well, and let's say it gets up to like 120, where this next area of resistance is, say it gets up to $120 per share, well, you're going to make well more than 10x your money. In fact, you'll make, what would that be? About $3,000. So you about 15x your money on that play. So interesting plays on Nike. Again, here's what I don't like. It's uncertain how long it's going to take Nike to recover, right? Like, let's say that you thought back here, I'm going to buy the dip by getting year out option contracts. Maybe you bought them right here or something like that, and you held, and there's an even bigger dip, and eventually it started recovering. You probably started making some money around here, but then if you tried to hold it all the way till expiration back down here, then that's just going to bleed out all of the premium, and you're not going to make anything. Or again, if you tried to buy the dip back here, same thing. You're never going to make any money on that. So that's the thing to be careful of. is the dip could just keep dipping, or it could just trade sideways for a really long time. Like if you look at what happened prior to this earnings call, I mean, Nike just went sideways for, look at this, 1, 2, 3 months of virtually no movement, right? 94.34 down to 88.8, up to 97.2, and it just kind of just up and down and real sideways like movement. So a 3 month batch of sideways movement like that, that to me is where I wouldn't be as comfortable going long in calls, but I would be okay doing cash secured puts on that. So I like the cash secured puts a little bit more than the calls. If I saw, again, some sort of base forming, the longer that base goes, the more likely I am to enter some sort of play for some upside potential. The other way I might mitigate against it is, this is another thing I could do, right? Say I buy these call 75s for 250 days out. It's going to cost me $730. What I could then do is I could come up here to this 30 days, and I could maybe sell these call 80s. That's not going to give me a ton of money. It's going to give me 30 bucks. But now that gives me a little bit of money to count against that 700 and however many dollars I'm spending, or $600 I'm spending, and I could continue to sell 30-day out contracts over and over and over up until expiration to help mitigate the risk there. Now, I don't think that's a great strategy if you're looking to go long Nike, because it's going to limit your upside significantly to where you, if in some world Nike pops over the next 30 days and all of a sudden this goes in the money, overall your play is going to lose money because you sold this, or excuse me, you bought this for a price greater than the spread here. And what I mean by that is you bought a call 75, you sold a call 80, so the spread there is $5. You spent more than $500 on this contract, which means you're not going to make any money on the play. So Nike's looking interesting. I'm going to keep an eye on it. I think this is a good turnaround play. I don't think Nike's going anywhere. It's people like Nike still. I think it's got quite a different story than something like Disney, where there is a little more uncertainty around Disney, where they maybe lost their brand magic, where people don't really get excited about new Disney stuff anymore. At least they alienated a large percentage of their consumer base. So, and I don't think Nike did that at all. So that's where I think the Nike turnaround story is a little bit easier to say, yeah, this is a good chance to just buy some shares, collect a little bit of a dividend, maybe sell some covered calls if you get 100 shares, right? If you have $7,000 to drop on it, start selling some covered calls on it to get a little bit, juice a little bit of extra money out of there, and just see what happens. Would love to know what you guys think. As always, hit that subscribe button. Catch you next time.